The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Trump takes center stage, and so too does political risk. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. We're kicking you off to the closing bell here in the U.S., and it doesn't look too good out there. Let me paint you a picture right now. The S&P 500 lower by 2%. We're just about at session lows when it comes to the S&P 500. As such, you can see the VIX on fire today in a bad way. Currently trading with a 20 handle. We were getting close to 21. If you're looking for a haven, you're not going to find it in the U.S. bond market. Of course, a lot of fears coming from overseas, from Japan. You can see that expressed in our 10-year Treasury yield, higher by about 7 basis points. The good news is that if you are looking for some safety, you're finding it today in gold. Gold currently higher by nearly 2%, Romaine, even as bonds fall.
Yeah, well, I'm going to unfortunately go back to the bad news there. That 2% drop on the S&P, you have to put it in relative terms. Relatively speaking, the Sell America trade is back in force. It's evidenced by treasuries rising the most since December, evidenced by non-U.S. stocks outperforming the most since November, and evidenced by the benchmark S&P having its worst day since October. The scale of the moves suggesting investor willingness to shrug off the political theater that's starting to wear thin. But just how far can the Sell America trade really go? After all, if you're not invested in the world's largest economy and the most liquid market, what alternative is there? Here's the CEO of the largest wealth manager in the world.
Diversifying away from America is impossible. I think that in any major asset allocation, one could probably think about having an overweight or underweight, but diversifying away from the U.S. and also from the dollar is a quite dangerous bet.
And to be fair, adding to his point, the latest market drama isn't just a reaction to the erratic messaging from the U.S. It's also tied to confusion around fiscal policy in Japan, which reared its head during the Tokyo trading session that pushed benchmark Japanese bond yields up almost 30 basis points. That's a historically rare move that nudged rates past Germany's, which could set the stage for a global reallocation of government bonds should these moves hold. So what pulls this market back from the brink? Maybe it's corporate fundamentals that save the day as earnings season shifts into second gear. Netflix reporting after the bell tonight, and while it's waiting in the benchmark indices, a bit too low to move the broader market on its own, the results could lift or depress broad investor sentiment, depending, Katie Greifeld, on how those numbers shake out.
Absolutely, and it's going to be exciting to actually talk about some of the fundamentals when it comes to Netflix, but let's get a check on that bidding war with Paramount for Warner Brothers Discovery. The news today was that Netflix was amending its offer to be all cash. Previously, it was cash and stock. Now it's all cash. That comes in at $27.75 a share. You compare that to Paramount's offer, which nominally is higher. That comes in at $30 a share, but that's for all of Warner Brothers. That, of course, includes the cable channels, which Netflix offers does not. You can see that Warner Brothers stock right in the middle of those two offers. Again, you think about the numbers that we're going to get tonight. It's going to be about subscription growth. It's going to be about the content slate, things along those lines. But you know, of course, that this is the elephant in the room. What is the future of this deal? Well,
let's talk about the elephant in the room, Katie. Harris Oakmark is a top 5 shareholder of Warner Brothers Discovery. And I'm pleased to say joining us right now is Alex Fitch. He's a partner and portfolio manager at Harris Oakmark. Alex, let's get right to it here. I mean, we've seen the revised bid by Netflix. We know what Paramount Skydance has on the table. Which side do you prefer?
Yeah, I think that's a great question. Our view is really firmly that these two bids, they are a toss-up. And the rules of this game dictate that a toss-up goes to the incumbent. Right now, that's Netflix. And so until Paramount comes forward with a substantially superior offer, this will be Netflix's deal to lose. And I think the really interesting thing that happened today is Warner and Netflix effectively accelerated the time frame that Paramount has to act within. You know, Paramount might have thought this was still early in the game. There was time to pursue all of these different alternatives. By moving to an all-cash deal, they moved up the shareholder vote on the Netflix deal into March, potentially, maybe as late as April, March. And that means that the clock's ticking. Paramount now has 2 months to convince the Warner board to agree to a deal with them. They need to move with a sense of urgency that they haven't been.
I am curious with regards to, I guess, less the fundamentals of the actual deal itself, meaning maybe what you get paid at the onset, but how this company, meaning Warner Brothers Discovery, gets managed over the months and years to come, and whether that ends up being accretive to whoever the buyer is. Do you think Netflix would maybe be a better steward of this, or maybe potentially David Ellison and Paramount Skydance?
Yeah, it's a great question, and the reason that we have two active bidders here that are so interested in this asset is because it's super accretive for both of them. For Netflix, there is no better home for content. You see how they take an old show like Suits and they turn it into a hit. Being able to do that across all of Warner's intellectual property, that whole library, that's an enormous opportunity. For Paramount, this is essentially a strategic imperative. You don't have scale or enough scale in what is fundamentally a scale business. So it's extremely important for them from a strategic perspective that they get this deal done. It remains to be seen which side's gonna push it further. But as far as we're concerned, there is still room for both companies to increase the valuation and still come away with a good deal for shareholders.
And Alex, I am curious, Romain sort of mentioned this, but you think about just how long the timeline is to get some sort of conclusion here, whether it be Paramount, whether it be Netflix. I mean, what are you, as a large shareholder, of course, of Warner Brothers, are you worried about that interim period? Because you think about Warner Brothers as a company having to continue to operate during that time period when they're kind of in stasis. I wonder how you think about that.
Yeah, it's a good question. I think it's the time frame until we have a resolution on who the winner is. It's looking like that's just a little bit over 2 months, hence the reason that Paramount needs to act now with a new bid. The time frame before closing and what happens in the interim, under the Netflix deal, part of the reason Warner's preferred that deal is because they can continue to go forward with the spinoff of their networks, which is one of the more important strategic things that they are doing. That's an option they obviously don't have if they go forward with Paramount, because Paramount's buying the entire company. It's one of the reasons they preferred the Netflix bid. Now, there are also advantages that Paramount has. For instance, potentially a somewhat easier regulatory path. It goes back to this idea that it really is a jump ball. There are puts and takes on both sides, and Paramount's going to have to differentiate themselves.
And Alex, while we have you, we have to talk about what's going on with the broader market right now, because you look at the S&P 500 down about 2%, currently at session lows, and all the different fears and concerns percolating in the market right now. How are you viewing this moment in time? Do you think that this is a potential opportunity for maybe some bargain hunting, or do you worry that this could be the start of something more substantial?
Yeah, well, at Harris Oakmark, we're long-term value investors. Our time horizon on any investment is going to outlast an administration. And we take a lot of solace in looking at history. If you look back in 2019, we didn't know we had a pandemic coming. We didn't know we had a spike in inflation coming. We didn't know about a tech wreck. We didn't know about Liberation Day. All of those things, all of those news items, and yet through it all, the markets, these companies, they've compounded value at such incredible rates. We think the key is buying good companies at a discount with a long time horizon and trying to look through all of the day-to-day noise that can shake your conviction if you're too focused on it.
Have anyone, with regards to the funds that you manage, Alex, has there been any sort of meaningful discussion about reallocation specifically around some of these political and geopolitical issues?
It's more about the opportunities that any of these swings create. We are valuing businesses every day, trying to find the next Warner Brothers where we can buy a $10 stock that we think is worth $30. And we're turning over rock after rock looking for that. Occasionally, these dislocations create that opportunity. Today, most of the opportunity is in the left behind stocks that you've had this 2 years where it's really been an AI-fueled momentum rally here. There are a large number of companies across sectors that still trade at very attractive prices that we're investing in today.
Hey, Alex, great to have you. Great insights, as always. Congratulations on Indiana last night. Alex Fitch, partner and portfolio manager over at Harris Oakmark, kicking us off to the close on a very busy day. When we come back, a deeper dive into tariffs and affordability concerns and how it could all affect early-stage investing. Pano Anthos, partner and managing partner at XRC Ventures, joins us in just a second.
And we'll stick with the current market action and hone in on what's impacting the fixed income space with Sara Devereux. She is global head of fixed income over at Vanguard.
And Netflix shares under pressure for a fourth straight day, down almost 29% since its last earnings report. Does tonight change anything at all. Full blanket coverage after the bell tonight of those Netflix earnings. John Belton, David Joyce, Mark Douglas, just a few of the names that'll be joining us in just a bit, right here on The Close, right here on Bloomberg.
Well, U.S. importers are paying the lion's share of President Trump's tariffs on foreign goods. That is according to a recent study showing that non-U.S. firms shouldering only about 4% of that burden. And it may not end there. Our next guest warns tariffs are worsening the affordability equation, with living costs in the U.S. rising by nearly $2,000 per household last year, fueled by higher prices on imported goods. Joining us live, I'm pleased to say we have Pano Anthos. He is founder and managing partner over at XRC Ventures. Great to see you in person.
Nice to see you, Sarah. Right.
So talk us through that a little bit, because, you know, the narrative so far is that, you know, you think about U.S. companies, they're eating a lot of the costs of tariffs versus, you know, the U.S. households, U.S. consumers themselves. But it seems like data is suggesting that this is also hitting households as well when you think about that $2,000.
Yeah, the costs are actually flowing on a kind of hidden basis, whether it's food costs, things like lumber, which cost, you know, create housing issues and costs associated with that. It's really like, it's a hidden set of costs that they cannot hold back on and they have to pass through. Mm-hmm. And if you're also, the other thing that no one's talking about is the sheer randomness of some of these tariff decisions and what it's doing to the import market, which is trying to maintain stability and pipeline for logistics and supply chain flows.
Well, let's talk about specific industries here, and I'm curious what you're seeing, particularly when it comes to retailers, an area that I know you have exposure to, because, you know, the knee-jerk reaction, you think about who would be impacted by, you know, these tariffs that we're talking about, random in nature, as you described them, you have to think that those are some of the companies that are first in line. Yeah,
and it's not easy to redirect to a different country of origin. You know, if you're slapping a tariff on China, you don't simply move your manufacturing to Vietnam tomorrow. Mm-hmm. And in many cases, you can't move at all. Metals is a great example. You're really stuck with supply chains that are well entrenched and are not going to be moving for 10, 15 years in some cases. As much as we would love onshoring, and we are a big believer in bringing on-demand manufacturing to the U.S., it's going to take a very long time. And so consequently, we're paying the price.
Well, I am curious about this, though, too, because when we talk about wages and affordability, I mean, there are a lot of people that will point to aggregate wage growth. And they'll say, look, when you look at wage growth and you look at inflation, things have more or less kept up. Obviously, we know once you get into the layers there, it's a much different story. If I'm an hourly wage worker, mm-hmm. and even a well-paid one, mm-hmm. why am I not above water, so to speak, when it comes to paying for the things I need to live?
Well, costs have gone up 50% faster than wages, and that is healthcare. And we all know that healthcare is not a controllable cost these days. Mm-hmm. Transportation has gone up dramatically. The cost of cars, for example, buying a car, leasing a car, renting a car. Childcare. It's not even in the Bureau of Labor Statistics numbers, but childcare is a massive impact on a third of the hourly workforce, of which 60% make less than $35,000 a year. And in 1960, when the poverty line was created, there's a new study out about whether the poverty lines now should be $140,000 a year, mm-hmm. on the basis of grocery bills as being a function of your overall wages. And now you look at the cost of living, and it's nowhere comparable to whereas in 1960, where you could have a single wage earner and someone staying at home. You have to have two wage earners because housing costs are so high. Yeah. And now you need childcare. And then childcare costs are going up by 30%.
I don't want to make this too political, but we talk on this program a lot about the problems.
Yep.
What is the solution? And the president last week, you know, gave a big economic speech that was supposed to lay out some issues in addressing affordability. I'm not sure we really got that. He's got a big speech planned for tomorrow that's also supposed to address these issues. What can actually be done? Or is it just sort of the organic sort of ebb and flow of the economy that we have to live with?
I think, sorry, you can go over really two areas. One is healthcare costs. There's at least 25% waste in the healthcare system, which is trillions of dollars a year. I'll give you an example. A startup that we backed cuts the cost of radiology by 70%. And radiology is 10% of all healthcare costs. By doing nothing, by just creating transparency, kind of the Uber of radiology. And who would have thought, if you had a scan done, you don't have any idea what that cost was. No. What other purchase would you make and not know the cost of it? Yeah. So the lack of price transparency in the healthcare system is a huge issue. There are alliances corporations are forming to actually reduce the cost. And then there's another hidden cost, the brokers. And I don't mean to, rant on brokers, but brokers are paid a commission, which means that the higher the cost of healthcare, the more they make. the incentives are all whacked.
I do wonder about the other side of it, the flip side of bringing costs down. What about when you think about wages coming up? You think about minimum wages actually rising in certain states. You point to California in your notes, for example.
Yeah, it's not going well, right? In two parts. One is there's not enough financial literacy in the hourly workforce. So, for example, most people don't know what an APR is. So if they use earned wage access to actually kind of pull up their salaries or cash, they're actually paying a huge price for that. They need to have the literacy to understand that that's a very expensive trade to make. And frankly, raising wages only works if you're keeping costs abated, and they're not. Costs are, as I said, growing double what wages are growing.
Yeah, and this has become a much more important issue, as I think a lot of voters have finally woken up to, well, they've felt the pain, but they've woken up to the idea of a lack of solution.
And it would have to be $35 an hour by 2035 to maintain a 2020 standard of living. No one can pay that.
All right, Bounce, we have to get you on to talk about that, particularly
Definitely.
in an election year where this will certainly be coming up time and time again. Pano Anthos is founder and managing partner over at XRC Ventures. And of course, as we talk about policies, we have to talk about this self-imposed deadline by President Trump on credit card issuers. Some of those stocks still down here as they don't quite understand exactly how they're going to cap rates at 10%. That conversation coming up after the break, right here on The Close, right here on Bloomberg. Let's get right to our top calls. Big movers on the back of analyst recommendations. And we start off with Domino's. Domino's Pizza. Morgan Stanley downgrading to equal weight. The price target cut to $4.55 from $5.35. Though the analyst is more bullish on the overall restaurant sector, it says Domino's, that narrative there remains challenged. You see the shares down about 3.5% here on the day. Next up, Intel. Sell-side optimism growing. HSBC upgrading to hold from reduce, almost doubling the price target to $50. Also, it got an upgrade out of Seaport today. All joining together here as they see the AI boom driving demand for Intel's products. That stock, after rallying 30% in the past 3 weeks, starting off this week with a 3% gain this Tuesday. Next up, ConocoPhillips. JP Morgan cutting to neutral with a price target of 98. The firm has a cautious outlook for the oil market given geopolitical risk from Russia, Venezuela, and Iran. Those shares down 3% on the day. Those are some of our top calls. Now, we do want to stay and take a closer look at another sector that's been facing a bit of an uphill battle, particularly because of government policies. That's the credit card issuers. KBW out with a new note today saying President Trump's call for a cap on interest rates would be difficult to execute and detrimental to card issuers, banks, and the broader credit ecosystem. The man behind that note joins us right now. Sanjay Sakhrani is managing director over at KBW. And Sanjay, let's get right to it here. When we talk about the detrimental effect, I know a lot of people can look at the differential between what a credit card rate is now and what a 10% cap would mean. But if it is just temporary, is there no wiggle room for any of these credit card issuers to find a way to preserve their profitabilities?
Well, I think that, in fact, is a question, right? Is it just for a year or is it for longer? Most cases, it's sort of a slippery slope. These things tend to take on a life of their own and extend further. But to the extent that it was for just a year, a 10% cap would still be a significant detrimental impact to earnings. We estimated that it would probably wipe out earnings for a couple of our credit card companies that we cover in this space, for Capital One and Synchrony. There would be some pretty devastating impacts to some other private label card issuers that we follow as well. So, depending on how significant a proportion of your customers are subprime, sort of near prime customers, the impacts would be greater.
Is there the potential, though, if let's say this came to fruition, and we should just point out for our viewers, this has a long way to go before becoming reality. But if it does become a reality, are there sort of incentives maybe, or lack of incentives, I should say, that the credit card companies can rely on to maybe make up for that price or revenue differential?
I mean, there are some offsets, like you have rewards, right? Like the rewards would probably almost instantly go away. And then you might have some other operating costs like marketing and such that they can offset some of those impacts for. But there's no question there would still be a significant profitability impact, again, depending on where in the credit spectrum you play. And then the question really is, how persistent it is. There have been So there's been some chatter about new products that might have 10% caps. I mean, I think those are really questions. Then you can at least underwrite based on risk profile. But to the extent that it affects the entire portfolio, I think it's hard to mitigate a lot of the economic impact because it's almost like 100% margin that you're taking out of the system. And you still have ongoing costs that you need to have for the business.
Well, Sanjay, you touch on what I was wondering about, and that is, proposals such as that from Bill, basically unveiling 3 new credit cards with interest rates that are capped at 10%, met with some skepticism. But is it surprising that we haven't seen more of these traditional card companies come out and try to basically seize this moment?
I mean, Built is sort of in the midst of a whole transformation of their product, and they are re-underwriting new customers because they've launched a new product. So I think they're a little bit of a unique situation where they're prospectively going after new customers and re-underwriting their own and making decisions accordingly so they can sort of manage that risk. I think with the rest of the industry, they obviously have a whole portfolio full of customers that they have at certain price points that they've underwritten at a price point. So it'd be sort of hard for them to do it on their back book. Now, prospectively, that is definitely something that they might consider. But, I don't know that it's something that's on the front burner. And obviously, this has sprung up in quite a bit of short time. And these things take longer sales cycles to develop.
And we only have about a minute left with you, but even if, this specific ceiling on credit card interest rates doesn't exactly come to fruition, when you think about the direction of travel coming from the Trump administration, this push for affordability, especially ahead of the midterms, what does that signal for some of these credit card issuers and for the banks in particular?
I mean, you have to take it seriously, right? Which is what I think the market is digesting right now, which is why the stocks are down as much as they are from their peak levels. I think if you look at sort of the performance of these stocks over the course of this year, the beginning started off really strong because I think for all intents and purposes, the background under which they're operating is really strong with the economy. I think this is taking direct aim at their profitability, and I think there's reason to proceed with caution, which I think they are. And I think there's more dialogue that needs to happen between these companies and the administration.
All right, Sanjay, really great to get some time with you. That is Sanjay Sakhrani. He is managing director over at KBW. Now, coming up, the stability of U.S. Treasuries in question, with Treasury Secretary Scott Bessent pushing back on, quote, false narratives around Europeans fleeing the trade. We'll catch up with Sara Devereux. She is global head of fixed income over at Vanguard. This is Bloomberg.
This is a false narrative that there is no talk in European governments. This was a report written by Deutsche Bank that this could happen. The media has latched onto this. I think it is a completely false narrative. It defies any logic, and I could not disagree more strongly on that.
The Treasury Secretary of the United States pushing back on reports that European financial institutions are ready to sort of weaponize their bond holdings, potentially dumping U.S. Treasuries as a political move, political retaliation. It's 3:30 p.m. here in New York. I've lost track of what time it is in Davos, Switzerland. The president, I think, just got off the stage at the White House down in Washington. There's a lot going on here that's moving the markets today, Katie.
Yeah, absolutely. And it was interesting to hear that from the Treasury Secretary because, to his point, earlier today, a Danish pension fund's CIO told Bloomberg that basically the U.S. government's financial position is not sustainable over the longer term. And it said that the fund would exit U.S. Treasuries by the end of this month. Certainly caught the attention of a lot of folks on Wall Street and certainly caught our attention as well. So let's keep this conversation going now with Sara Devereux. She is global head of fixed income over at Vanguard. Sara, it's great to see you on Today of all days.
Oh, great to see you.
So let's start with the big question, the scary question out front. You think about, that conversation that's being had over whether or not, U.S. Treasuries have the same credit quality that they once had, especially when you consider some of the positions that the U.S. has taken, potential action in Greenland. Where do you fall on that question?
Look, I would say if there's one thing we learned in 2025, it was to expect the unexpected. Right? We saw a lot of volatility in April. Right, a lot more volatility than we're seeing today, frankly. And if you zoom out a little bit, it ended up being a great year despite that. It was a great year for stocks. It was a great year for bonds.
So maybe just a slightly earlier hiccup when it comes to 2026. But let's talk about what is going on in Japan, because you take a look at the U.S. Treasury market today. You have yields 10 to 30 years yields higher by 6 to 8 basis points or so. We're hitting all-time highs when it comes to what's going on in Japan's bond market. How much of that spillover explains what we're seeing in the U.S. Treasury market today, and how much more could there be to come?
So it's definitely something to pay attention to. We've been short GBs for a while, just expecting the hikes to come, and they did come. This last move, though, in the last 48 hours, really 4 standard deviation move. You start to see some, be careful what you wish for, a little bit of instability in the market there. So we do think that's something to watch. What comes to mind is, do you remember the yen carry trade unwind in 2024?
Never forget.
A lot of disruption there that moved, globally. We think at this point that was a little bit of a warning. People took their positions down, so we're less worried about the spillover effect now. But it does sort of bring the topic of term premium to mind, and that's a global phenomenon.
Well, I'm curious of what you think about that, though, because, obviously a lot of the moves that we saw in Japanese assets was largely because of that auction and the response to it. The U.S. isn't quite there, but there's been a lot of talk that at some point maybe U.S. Treasuries have that same moment where they have a big auction, particularly on those long-dated bonds, and investors basically revolt.
So I definitely think term premium is a watch item, right? And that's something we've been talking about for some time. What is term premium? Term premium is a risk premium, right? It's really driven by the deficit, and it's driven by supply and demand of U.S. Treasuries, right? So anytime we're talking about the deficit going higher, we see the term premium move. Now, I would say there are a few mitigants when we're thinking about the term premium in the U.S. The first is just that on that deficit discussion, there's definitely more buy-in to that growth narrative, right? Can we grow our way out of it? If the deficit stays the same, everyone's sort of expecting this AI boom in growth, can that debt to GDP ratio go lower? So that's one. The second mitigant to the term premium really is just that it's repriced. If you think back to September 2024 when the Fed started cutting rates, the term premium is more than 100 basis points steeper. Think about that in a world. How many people come on the show and say risk premiums are compressed, credit spreads are tight, I can't believe the valuation of equities. The risk premium for 10-year treasuries has gone higher, so people are getting paid to go out the curve. And like the third mitigant, I would say, on the term premium is really the administration's focused on it, right? Affordability is top of mind. We've seen the action with mortgages, and we saw a lot of action last year on supply and demand dynamics in the treasuries. We expect that to continue.
I am curious, with regards to investor allocations, is there meaningful competition right now between how people, whether they're buying government bonds relative to corporate bonds? And I'm pretty much talking about investment-grade U.S. bonds.
Yeah, look, when it comes to credit, I think there's a lot of talk out there right now about complacency. I'll be the first to say, we are not complacent about credit. We are pretty convicted about credit and our strategy around it. Spreads are tight, right? Spreads are tight. That means you have to have discipline, and you have to have vigilance, and you have to have precision in order to extract that value. But fundamentals are really good. Fundamentals are strong in the public credit markets. And when you think about that spread over treasuries, people are just talking about the spread. But I think what you also need to talk about is the spread from IG to high yield, the spread from high yield to private credit. So that spread to go down in credit is also compressed, right? So when spreads are tight, that just means there's not a lot of room for error. And we don't think the credit cycle has turned, despite some, headlines about that. When it does turn, it typically happens from the bottom up. So we're just trying to be prepared, stay up in quality, pay attention to security selection, and we are keeping a little bit of dry powder on the side should spreads widen from here.
Yeah, absolutely. Well, let's talk a little bit about fundamentals, specifically when it comes to privates, because you talk about, you think about how tight spreads are when it comes to investment grade, when it comes to high yield, fundamentals sort of match what you're seeing there. Does that story hold when you go a little bit into the private markets?
So on private credit, look, it's a market that developed very quickly. It's grown very quickly, and we think it is an asset class that is here to stay. It does have many benefits for investors, that illiquidity premium and diversification, et cetera. So we think there's some great things. Now, that pickup versus public markets has compressed, and private credit is untested, but it just really underscores the fact that you need to stay focused, you need to be diligent, you need to work with a great manager to extract that risk premium.
I do want to get your thoughts on the potential increase in issuance that we might see from some of the big tech companies as this AI build-out continues. I know towards the end of the last year, you had some people kind of grumbling, saying this could kind of distort things in the broader bond market. Any worries?
So I would say, look, AI CapEx is a massive macro theme. It underpins our forecast for GDP to be strong. And what's been happening to date really is these hyperscalers have used free cash flow, right, to fund this CapEx. But what we started seeing late last year is that they're starting to raise debt. Right? And what does that mean? It means increases leverage to the AI trade, and also increases supply to the bond market. Hyperscalers issued about $100 billion late last year. Compare that to 2024, it was about $20 billion. When we look forward in 2026, we see upwards of $300 to $400 billion, not just hyperscalers, but for AI CapEx, and that is material amount of issuance. That's about 15% of the IG issuance overall. So we do think it is a technical that you need to keep an eye on. That being said, these are very high quality issuers, very strong credit. And so we would play it, if we see any material widening due to a technical, big deals, indigestion, whatever it may be, it's a great opportunity to add high grade credit.
All right, Sara, always great insights out of you. Sara Devereux, one of the best in the business, global head of fixed income over at Vanguard. When we come back, a closer look at the sell-off on Wall Street, session lows for stocks, a big move higher on yields and a big pop in the VIX. A lot of questions here about some of the policy positions and proposals coming out of President Trump and, quite frankly, everyone out at Davos. A breakdown of all of today's market action when we come back right here on The Close on Bloomberg. 67.92 and change is the low of the day for the S&P 500. Not far off that as we get closer to the closing bells. A lot of concerns about a lot of policy proposals coming out of the president, and more importantly, some of the responses that we might get out of European leaders upset with some of those proposals. Michael Ball joins us right now, macro strategist and reporter here at Bloomberg News. Talk a little bit more about what's moving the market, and more importantly, Michael, about what, if anything, actually arrests this decline. I mean, we're actually bumping up against some key technical levels now that I would assume, if breached, could maybe presage further downside.
Yeah, the 6,800 level was being a key battleground area in the past. It's obviously psychologically important, but also option positioning below it are much more negative, so it would be much more fluid decline. We've had resistance in this other 6,900, 7,000 area for the last 2 weeks. We stuck around there for a while. We never quite got above 7,000, but we're bouncing around. That's all evaporated now. To your point, we need the tone taken down, the geopolitical tone, that is. Obviously, we have the Greenland issue, which is forefront. We'll see what Davos brings tomorrow. I know he's going to be talking about housing, but he has the opportunity to at least have some photo ops with other European leaders to show that they are still getting along, that NATO is not in peril. Yeah. And obviously things like Iran, some of the peripheral stuff needs to come down as well, because oil's been creeping up. Interest rates have been getting a little more volatile as yields and the curve has steepened.
Yeah, it will be fascinating to hear the tone that President Trump strikes tomorrow at Davos. I do want to point out that we have sliced through the 50-day moving average when it comes to the S&P 500, but it's interesting. So we're close to session lows when it comes to the S&P 500, down about 2%. You take a look at the Russell 2000. I mean, it's not green, but it's not as red, down about 1.2%. So you
performance, Katie.
Exactly.
Like
you could make the case that the rotation still holds here.
Yeah, exactly. And that's what we are basically focused on as the bullish case here, if you want to take the silver lining. Because, it shows that people are still gravitating to this reacceleration story. And on top of basically looser financial conditions from past Fed easing and the one big beautiful bill, Q1 earnings are still pretty positive. So if you look at the micro, especially by sectors, some of them have very compelling stories to chase. While overall, the geopolitical uncertainty and the overall policy coming to the forefront, is again weighing on the macro narrative.
So this gets to the idea, though, too. I mean, we're heading into earnings season where I think most people had pretty high expectations. Right. And I'm wondering why that, or maybe it does eventually drive the market a little bit more than geopolitics. But at the end of the day, for all of what's going on in Davos and beyond, at the end of the day, we still have a relatively healthy corporate profit picture, at least for the larger cap companies, certainly so. And I'm wondering if that might be enough to kind of keep things going, assuming these companies actually make good on those expectations.
Well, that's the question. What's priced in? Obviously, the Russell small caps have come up massively since the November lows. How much of that now is basically baked into this expectations that earning growth is going to be pretty meteoric? It's going to go exponential. It's about 67% for the year, which is a huge number for them. And obviously, we've seen head fakes here before. So now we need the data to actually cooperate. We need earning forecasts, not necessarily what we get in results the next few weeks, but the guidance to be better than expected. And we actually need the hard data to materialize. And we have a little bit of a break before we see jobs reports again, but that's the key one to keep watching. The no hire, no fire must continue.
Absolutely. The data is clearly still in focus here. Before we let you go, Michael, let's just talk quickly about what we're seeing with the VIX. We highlighted it at the top of the show. We are trading above 20. That's only the highest level since November, though.
Yeah, look. It's interesting. We've had some developments in the last couple of weeks where you had a lot of short spot VIX trading, meaning people were selling vol over the holiday season, and that was kind of bringing down the VIX below 15 and says 14, while the curve itself was steep, meaning people were expecting volatility to pick back up in the first couple of weeks of January, and subsequently now we're seeing that. So VIX, funny enough, as a curve, has really come through and shown that exactly what we would have expected. But now the worry is that a lot of that short vol selling, which has suppressed volatility, is now gone because of all the uncertainty. So there are technical factors here I'm bringing up, but in actuality, though, it's actually predicted well the markets, today being the case example.
All right, Michael, great to get some time with you. That is Michael Ball. He is a macro strategist and reporter for Bloomberg. Coming up, we'll take you to the closing bell and preview those Netflix earnings with Sara Kunst. She is founder and managing director at Cleo Capital. This is Bloomberg.
We are valuing businesses every day, trying to find the next Warner Brothers where we can buy a $10 stock that we think is worth $30. Today, most of the opportunity is in the left behind stocks that you've had this 2 years where it's really been an AI-fueled momentum rally here. There are a large number of companies across sectors that still trade at very attractive prices that we're investing in today.
Alex Fitch, portfolio manager over at Harris Oakmark, one of the top 5 shareholders in Warner Brothers Discovery, as we count you down to the close, and more importantly, Katie, count you down to Netflix earnings.
Yeah, looking forward to those. A difficult market to report earnings into. Let's take a look where we stand minutes away from those closing bells. The S&P 500 looking set to finish at session lows, down by more than 2%. I thought this was funny. We were talking about this with Michael Ball. You take a look at the Russell 2000, your small caps, down by more than 1%, but still outperforming the big benchmark today there. And then you take a look at the bond market, and again, things get ugly. The 10-year Treasury yield higher by about 6 basis points. There is no haven to be found in the U.S. bond market today, but you are finding it in gold, higher by about 1.8%, firmly above $4,700 an ounce, Romaine.
Yeah, and we take a look at one of the bright spots actually here on the day. It's actually Boeing. The share is only up 0.6%, but a milestone, if you will. This has now erased all of the losses that Boeing has had, going back all the way to early January of 2024 after that panel blowout that it had on an Alaska Air flight. Added to a lot of questions here about, well, just the safety and reliability of those jets. Led, of course, to a lot of changes at the top, a lot of changes at the bottom. And those shares, of course, finally bottomed back in March of last year, or April of last year, I should say. Now, relatively unchanged from that big plunge back in 2024. But we do want to go back to Netflix as we await those earnings with a big focus on their revenue growth and some big questions here about the bid for Warner Brothers Discovery. Sara Kunst joins us right now, founder and managing director over at Cleo Capital. And Sara, let's first start off with Netflix's actual business. Let's take Warner Brothers out of the equation here, because prior to this quarter, it seemed like investors were kind of reticent about what was going on there, despite that you still had decent revenue growth, despite the fact that you had decent margin expansion. What exactly do investors want to see that's going to get them more excited about this stock?
You know, I think one of the questions over the last year has been how many people are using this thing. Remember that in 25, they stopped reporting out user numbers. And I do think that there's a question mark there of is there a little bit of you know, kind of hide the cup happening where U.S. users, we know, are paying kind of more and more and more, but are there fewer of them? Did cracking down on password sharing in places like the U.S. work? How much are people paying in other markets? And so I think that there's just a question mark of, if this business is so great, why do we know so little about it?
Yeah, and that was a big question, of course, when they first announced that they were going to stop providing the subscriber numbers. It gets to this idea about where growth comes from Netflix. And this, what is now, I guess, effectively an $80+ billion bid for Warner Brothers Discovery. Is that the answer? Is that growth?
that is something. I think that we're going to see later today exactly how the market feels about it. Is it growth in an organic sense? Is it growth in the sense that a lot of the businesses they would fold in make a ton of sense with their core business model? Maybe not. Is it something sort of big and splashy that they can get funding for and use it to say, look, we have a plan beyond just getting people to pay for us versus, the other streamers? Yeah. So it feels to me a little bit like a right now measure, not necessarily the long-term future of the business.
Well, you think about how the stock has moved since their last earnings report in late October. Shares are down roughly 29%, give or take, since then. That was really about when it comes to the slowing growth, when it comes to subscribers. But I wonder, how much of a weight, and I know it's impossible to calculate, but how much of a weight is this overhang of this deal and whether or not they're going to be able to close it?
Well, I think you have to remember that this isn't a normal deal, right? On the other side of the deal is sort of the president's best friend's best boy, and that's tricky, right? And we know that right now we're in a political environment that if they run afoul of that relationship, it could be tough. And so even if you think maybe that Netflix is well poised and would be a great guardian of the Warner Brothers brand, you do have to look in this case at who misses out then, and really ask what, if anything, is that going to cost the Netflix business? And so I think that there are a lot of things to consider here, and it's just kind of too soon to tell how it's going to shake out. And if it doesn't shake out, how much money they are going to spend on pursuing this acquisition.
Absolutely, and it'll be interesting to get maybe some more details in the next 10 minutes or so. And then, of course, there is the earnings call to look forward to as well. But let's talk about tech in general right now, Sara, because you take a look at the sell-off underway. Big tech certainly bearing the brunt of that. And you look at some of the details here. I mean, are you seeing this as an opportunity to maybe add to some of your favorites, or what do you make of today's action?
Yeah, so, I think a lot of this little sell-off is obviously driven by the very uncertain macro, and people sort of betting, hey, would the EU ever kind of pull out their bazooka with the ACI and say, we're going to tariff U.S. tech services, which would be a very big change in a lot of these companies' business models. And so, there's a lot of uncertainty that has very little to do with these companies. I think a lot of what we are seeing is people locking in gains of an amazing bull run. That being said, Mag 7's not a monolith. There are names that I like a lot more than others. Tesla is not one I would be buying on the way down right now. They're not selling the cars to make that make sense. But then there are other names like Alphabet that I've long said I think will be the ultimate winner in AI, and certainly seems to be heading that way. And so for those kinds of names, I think that it's not bad to look at them and say, if I liked this last week, maybe it's better now that it's cheaper.
Sara Kunst, founder and managing director over at Cleo Capital, helping us count you down to those closing bells. Just about 3 minutes ago, of course, Katie, there'll be a big focus today on those Netflix earnings with expectations for 17% revenue growth, 25% profitability growth, but obviously a lot more questions probably about that Warner Brothers Discovery deal.
Yeah, it's going to be interesting to see how the sort of breakdown of the analyst calls, what that actually looks like. But I mean, there's a lot of questions too about, if we do see this deal go through with Warner Brothers, what does that mean for the future of theaters, for example? And what does this mean, where Netflix stands as sort of the king of streaming here? I liked your question to Sara, whether or not you think about what's the next growth lever for Netflix. Is it Warner Brothers? I'm not sure.
Absolutely here. And just a reminder, despite the outsized importance Netflix has on investor sentiment, it is still a relatively smaller weighting on the broader market, right around session lows, 67.96 and change on the S&P 500. A full breakdown of today's market coverage and a full breakdown of Netflix earnings starts now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Katie Greifeld taking you through to that closing bell with a global simulcast. It started. Carol Massar, Tim Stenovic, they're in the radio room. Welcome to our audiences across all of our Bloomberg platforms, including our partnership with YouTube. A massive sell-off going on right now in U.S. equity markets. We should point out 67.89, that's the low in the S&P 500 on the day. 67.45, that's your 100-day moving average. S&P right now, Carol Massar, at 67.94 and change.
Yeah, I mean, we're hovering near our worst levels of the session. We saw, selling certainly accelerate kind of early mid-afternoon here. So definitely seeing, I think it's, what's interesting is it's broad-based selling, right? We're seeing really across the board investors. I wouldn't say they're running for the exits. It could be much worse, but it'll be interesting to see what we see in tomorrow's session.
Yeah, 4 stocks lower for every 1 stock that's higher in the S&P 500. Today, with the S&P 500 down just over 2%. The worst day going back to October of 2025, Katie, the S&P fell 2.7% on that day. Right now, we're trading at just about levels last seen on December 18th.
I do want to point out volume through the roof right now on the S&P 500, about 41% higher than the 30-day average. But as Romaine and I have been talking about, the small caps still outperforming, still down, but doing better than the big guys.
Yeah, believe it or not, an outperformance by the Russell, even on a decidedly down day. And of course, the elephant in the room is not just the geopolitics, but also earnings season, which really kicks into second gear in just a few minutes with results out of Netflix. Read across the screen here on the Tuesday, the start of a holiday shortened week here in the United States, coming off the Martin Luther King Jr. holiday observance. The S&P 500 down more than 140 points, or about 2% here on the day. The Dow Jones Industrial Average down about 1.8%. The NASDAQ indices each down more than 2% here on the day. And the Russell 2000, relative outperformance, but still deep in the red, a drop of about 33 points, or 1.2%.
All right, so stocks down across the board. Let's go to the S&P 500. 401 names losing ground on this Tuesday. 100 to the upside, Katie, 2 unchanged.
Let's take a look at the sectors as measured by the Circle. And it looks pretty scary today because it's all red. In terms of what really dragged us lower, it was information technology, down by about 3% as a sector. Consumer discretionary, financials also taking quite the hit today. In terms of what did well, that tiny slice of green on your screen, that is consumer staples, managing to squeak out a gain of about 0.1%, Carol.
United Airlines crossing the wire right now. Let's get right to it here. We had gotten a little bit of a sense here of how the airlines were doing after the results last week by Delta. United saying that in the fourth quarter, CapEx at $1.89 billion. EPS looks like a beat at $3.10 a share. The street was looking for $2.92 a share. Operating revenue, $15.4 billion, relatively in line with estimates. The shares up fractionally here in the after-hours trade.
Meanwhile, let's get to Netflix here, crossing the terminal. And this is the red headline. When it comes to 2026 revenue, the outlook there, $50.7 billion to $51.7 billion. The estimate had been for $50.96 billion. Meanwhile, you take a look at in terms of what we saw when it comes to the fourth quarter. You saw fourth quarter revenue come in above expectations, coming in just over $12 billion. The estimate had been for $11.97 billion. And then their free cash flow in the fourth quarter coming in at $1.87 billion versus $1.46 billion. So when it comes to the look back, fourth quarter EPS also coming in above expectations. It looks like we beat on a lot of metrics, but then again, you go to the 2026 numbers, ad revenue seen about doubling versus 2025, and their second half 2026 operating income growth to exceed the first half, but still you can see that investors finding something to not really like in this report. Netflix shares currently down about 1% after hours.
Yeah, perhaps it's a cautious forecast. It cited higher program spending, the cost of closing its deal with Warner Brothers Discovery, so certainly a lot hinges on that if that deal goes through. The company does plan to increase spending on films and TV shows by 10% this year. It forecasts earnings of 76 cents a share. Wall Street wanted to see 82 cents a share. We'll see if that Warner Brothers Discovery, I mean, I'm sure that's going to be the question that analysts are looking for, especially now as the company has changed what its offer looks like, going all cash at this point.
All right, so Netflix still down about 2% here in the aftermarket. We're certain that that will come up on the call with analysts. In the meantime, let's go back to United Airlines, because certainly a great read on the consumer. We did see United actually beating Wall Street estimates for the fourth quarter. It anticipates a strong 2026, driven by strong demand from high-spending domestic passengers and those international travelers. So they're looking at full-year earnings per share for 2026 to be in a range of $12 to $14 a share, compared to the $13.06 that analysts are predicting. Keep in mind, their results driven by demand, again, for those premium seating and overseas travel. Premium revenue up 9%, loyalty revenue up 10% in the fourth quarter, and that stock popping up now, up about was up about 2.25%, now up about 1.5% here, guys, in the aftermarket.
All right, I do want to go back to Netflix here. We need to dive a little bit deeper into these numbers, because this isn't just a revenue and growth story, it's a cost story as well, with the company saying that it will boost by about 10% its spending on programs. But it released a supplementary statement that's on its website talking about what's actually driving that. And a big driver of this, no surprise, is actually non-English language titles, saying they accounted for over a third of the viewing that we saw in the most recent quarter. They specifically cite Korean, Spanish, and Japanese shows. They also talk about this big push into other markets in Europe, including Denmark and Norway, speaking of which, but also the idea of an expansion of some of their comedies, an expansion of some of their live events, all of which, we should point out, will cost them a lot more money. And the question is, are investors going to be comfortable with that spend, particularly potentially on top of another $82 billion or so that it might have to pay up if it does win the rights for Warner Brothers?
Well,
yeah, go ahead, Katie.
I was just going to say, it's interesting. You can also see in the commentary, Netflix plans to pause its share buybacks to accumulate the cash it needs to help fund that pending Warner Brothers acquisition. They amended that bid to be all cash, as a result pausing buybacks, typically not exactly popular among shareholders.
Yeah, and we should point out that this all-cash bid, which we keep talking about, a lot of that, more than half of that, is going to be actual debt. So you're not only talking about a depletion of cash on the balance sheet, you're adding debt to the balance sheet, and then, of course, there's this general idea here as well of all the other spending that they have to do.
Yeah, continuing to look through the supplemental materials that Netflix released in these earnings, shares down after hours by about 3.3%. The company said originals that Netflix originals that thrilled audiences everywhere. Of course, K-pop Demon Hunters, Stranger Things, Wednesday, but then also an entire section about non-English language titles that remained widely watched. The Great Flood in South Korea, Love Untangled, Bon Appetit, Your Majesty. In Japan, people like The Last Samurai Standing, Season 1. There are numbers in here, too. That title, 21 million. For example, Spain had several popular shows, Brazil. Netflix making the point and saying this, hey, we've got something for everyone out there, no matter where you live, no matter what you like.
I want to go back to what, Romain was talking about, the spend. And certainly we talk about these guys all the time, all of the streamers, in terms of the spend in order to get content so people are signing up and staying on their platforms. Having said that, the company, again, going back to the year forecast, seeing operating margin 31.5%. The estimate was above that at 32.4%. Sees free cash flow about $11 billion. The estimate was almost $12 billion. But I want to go back to the commentary. The company saying it sees, quote, plenty of room to increase margins. Company intends to grow operating margin each year. So, right, we talk about the spend, but we also talk about, what that does basically to the profitability, Romain, of that company.
And we talk about the margins for the most recent quarter coming in at about 24.5%. That's the operating margin, we should point out. And that is up from about 22% year over year, but it's still relatively in line with estimates. And I guess the big question I have, and we should just a reminder that conference call, which is really just a kind of a one-on-one interview, more or less, kicks off in about, I think, about 40 minutes time here. They've got to really reconcile this idea of how much you spend relative to the actual return on profitability. And does this, I guess, when I reading through this report as a Netflix user, the first thing that comes to my mind is, does this mean they're going to have to raise prices, subscription prices?
Raise prices again.
Yeah.
Yeah, I mean, Netflix used to be huge news when the company raised prices. It went years and years without raising prices. And people would say, wait a second, my cable bill's going up every single year. I'm paying more and more.
Yeah.
Is that what Netflix is turning into? And, how elastic are these how much price elasticity does the company have?
Yeah, all right. So lots of things that can come up certainly on the call. Good point. Netflix, guys, down about 3.5% here in the aftermarket. United Airlines also out with earnings after the close, and that one is now rallying just about 1.8%. So we'll continue to track for you. That is a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. We do call it the closing bell. Romaine and Katie, of course, continuing there on the open on, on the close. It's,
If
Monday,
they stay long enough, they'll get
Tuesday.
to do the open.
Yeah, if you don't go anywhere. On the close there on Bloomberg TV. And of course, Tim and I continuing right here on Bloomberg Business Week Daily on Bloomberg Radio. We'll see you again. Same time, same place tomorrow.
And a deeper dive into those Netflix earnings, 18% revenue growth in the most recent quarter to about $12 billion, 56 cents a share in profitability on EPS relative to 43 cents that they posted about a year ago. Operating margins slightly higher at about 24.5%. Free cash flow right now, $1.87 billion, up 36%. But some big questions here about what that cash flow looks like going forward. The company does say that for the full year, the current year we're in, look for revenue of about $50.7 billion to $51.7 billion, the low end of that range, relatively in line with estimates. David Joyce joins us right now, senior analyst at Seaport Research Partners. He's still got a buy rating on the shares and a price target of 115. All right, David, the share is under pressure here in the after-hour session. What do you think people are focusing on here most?
So, they did beat in the December quarter, but it's always about what are you going to do for me next? And while the revenue guide was a little better than expected, the margin was a little bit lighter for the guidance. So I think, people are concerned that maybe the Warner Brothers Discovery deal does have something to do with a long-term growth outlook that the management has that might not be as rosy as investors had. I don't think that's yet the case. I think that'll still take time to bear out. I think there's a lot of opportunity on the advertising side. And generally, I have a buy rating because I think the stock has fallen too much. But now that the news is out, this is a sell on the news event. But I don't think it's deserved from a long-term perspective.
Yeah, it does get to that question about valuations. I was actually surprised at how low the shares were, at least relative to where they were last year. I mean, this is a stock that's basically been under pressure since the last couple of earnings reports. When you look at the spending numbers, though, the idea of increasing spending on content by 10%, which in and of itself wouldn't be a huge issue, but you overlay that with the Warner Brothers bid, does that concern you at all, that might put further pressure on its valuation?
Well, they need to spend to attract and retain viewers, and it needs to be a global perspective. They do have to compete against a number of other parties for the content. So the spending is important. But I think that you have the potential for Warner Brothers content coming in, but that's still going to be 12 or 18 months out. They did just sign a new Sony Pay One deal through 2032, which is global. So they do have access to a lot of content. But I think that this is a case of kind of forgetting in the short term that the company does need to start out the year under promising so they can over deliver. So I think that there could be room for some more margin expansion as the year plays out, but we do also need to see them, post the advertising growth and, the top line growth and the margin expansion. So I think it's, we're in a show me kind of state. So that's why the shares are trading down a little bit here in the aftermarket.
Well, to that point on margins, the company says that they see, quote, plenty of room to increase margins. We'll see if that comes through. When it comes to the ad business, the company also said that they see about a doubling of ad revenue in 2026 versus 2025. But as you said, we're in sort of a show me stage when it comes to Netflix. And if you don't know the base number, how useful is a qualitative metric such as that?
Well, we've triangulated on what we think they're generating. We think they did $1.5 billion in the fourth quarter and did $3.1 billion in 2025. We had them growing the advertising by 2/3 next year, or 67%. So, the guide that they would be doubling it actually should be viewed positively. I think that's something that helps to show that their ad tier strategy is working. Their strategy strategy in France of having more live programming is working. Their sports strategy is working, and that's where some spending is being allocated. And it all is heading in the direction of driving up user engagement, which is an area where they've been lagging versus YouTube TV, for example. So I think that the ad guidance is a positive for the long term, because that should generally be lifting its overall ecosystem as we look out several years.
And it's interesting, David, you take a look through some of the commentary, again, waiting that interview that the company does in lieu of their earnings call. But there's a lot of focus on some of their non-English series, their shows that have performed particularly well. And when you take a look around the globe, I mean, how big is the potential addressable market here for Netflix, and how saturated is it already?
Well, they have well over 300 million subscribers globally, so there is still room to expand in a lot of markets outside of the U.S. beyond what they've done. The U.S. is fairly mature at this point, but you do have some uplift in subscribers as the password sharing strategy has been taking hold for the past year and change, which has also resulted in more ad tier subs and therefore more advertising. So I do think that there is more penetration to come, internationally in Asia, maybe less so in Europe and the Middle East. But I think that those are still going to be some good new long-term growth areas. And part of the reason that they are investing more in that local content from those regions is to drive that very engagement and expand the user base.
I am curious on the engagement side, and I'm glad you bring that up. They got a little bit of a criticism after the success of K-pop Demon Hunter seemed to take them a little bit off guard, and there were a lot of questions as to why they pulled it from the theaters so quickly. I know they set up Tudum and some of these other sites that are supposed to kind of keep the fan base active and engaged, even in between, whether it's a series like a Bridgerton or something like that. Do you see them investing more in that, if not money, certainly more time and effort?
I do think that they have a view to using the theatrical releases as part of their overall marketing vehicle and something to drive up engagement. One of the things that they'll be probably talking about some more on the call is the upcoming Narnia movie in November. That'll be on IMAX first, and then it will come to Netflix. So I think that they're still learning how they can integrate with the various outlets, for the content that they have access to. The bigger tentpole kind of new productions are more and more likely going to have a theatrical aspect to it. It helps. Again, in the visibility, the marketing, the voting process to win awards. And that also would play well into their strategy with trying to win the Warner Brothers Discovery deal and get that through the regulators.
All right, David, really appreciate your instant analysis here. That is David Joyce. He is a senior analyst over at Seaport Research Partners. Let's keep this conversation going now with John Belton. He is a portfolio manager and managing director for growth portfolios over at Gabelli Funds. John and his firm own shares of Netflix. And you take a look at the reaction, as we were just discussing with David Joyce. It seems like most investors taking this as a sell the news event. As you parse through these numbers, is that your knee-jerk reaction as well?
Yeah, thanks for having me. I mean, I think the top line numbers generally look pretty healthy. Good update on the subscriber number at over 325 million. That suggests that 2025 was another pretty solid year for member growth. I think the big disappointment in terms of the numbers is just on the margin guidance, 31.5%. I think that adjusts to about 32%, if my math was correct, if you back out that acquisition-related cost number that they flagged. So I think that's probably okay, but a little bit short of expectations. So you probably have slight negative earnings estimate revisions would be my first cut at it.
And John, what we've been talking about since the numbers came out is just the amount of spending that Netflix is going to have to do. First, when it comes to its content slate, then you think about this potential Warner Brothers deal, which has, taken a lot of twists and turns. And in their commentary, Netflix writes that they are going to pause share buybacks to accumulate cash to help fund that pending acquisition. Again, as an investor, are you concerned about the potential spending that they need to commit to here?
Well, I think the pause in the buyback is really no surprise, but I think if we take a step back, Netflix is coming off a couple of years where they've really held content spending more or less flat over the last few years, and that's allowed for some pretty sharp margin expansion. I think that content investment cycles for this business are going to kind of ebb and flow in multi-year periods, and we are probably entering a period of slightly higher content investment. But I do think if this Warner Brothers deal closes, one of the benefits is going to be a much bigger content library, which could, in theory, mean slower or less need to invest so aggressively to grow that library over time.
Yeah, it's kind of interesting, too, John. In the release, they talk a lot about how they see Warner Brothers as a complementary to Netflix. You would expect that. But in that context, they were also talking about all the competition out there. And actually, according to them, saying that they actually account for less than 10% of TV viewing time. And they're basically putting that up against not only the traditional TV companies, but also the YouTubes and the other streaming services of the world. I am curious as to whether you think they need to keep up with some of those other folks, or whether they can sort of be in their own sort of lane or niche, if you will.
Well, I think that is a sentiment that they've talked about consistently over many years. The fact that they don't just compete with the traditional media companies, the cable network companies. They also compete with any content platform that is driving consumer attention. So they've always competed with social media, with YouTube, and I don't think that's any different going forward. Do they need to continue to invest to keep up with that? There's nothing different. I think, of course, they do, but I do think they're carving out an interesting niche as something that stands alongside user-generated content and it's professional-generated content. And I think they'll always have that niche, and that will always help differentiate them.
I am curious that when you look at just the current valuation, and we should point out this stock has been on a pretty long downtrend for the last few months, some of it related to some of the specifics that we talked about today. But I am curious as to what you think sort of arrests that decline. Is it just it gets cheap enough that people come back in, or is it maybe what we hear on the conference call in about 15, 20 minutes time?
Yeah, Netflix, it's always been a stock where I think the stock has always followed the estimates, and you've had this multi-year, really positive estimate revision story driven by, you've had a reacceleration in member growth, but more than that, you've had this advertising story and a paid sharing story. And so you've had this couple-year period where earnings growth has really exploded, and you were always going to be entering this sort of more mature phase of the growth cycle. And then along with that comes this Warner Brothers announcement, which the stock has sort of been in the penalty box a little bit around that. So going forward, I think if they can just stabilize fundamentals and show that this advertising story still has legs, which I do think this guidance for doubling ad revenues again this year is another big positive in the release. I think that's how this stock gets going again, return to positive estimate revisions.
Right. I mean, you mentioned the stock in the penalty box. You think about how it's performed since it last reported earnings in late October. We're talking about a decline of maybe 30%. It's certainly, if these losses hold, going to be greater at the open tomorrow. But when it comes to the Warner Brothers deal, I mean, is there a number that you have in mind where it just wouldn't make sense for Netflix to bump this up any higher?
I really want to stay away from talking about that deal for obvious reasons with our firm. But, the way I'm thinking about Netflix's stock from a high level and going forward is, yes, the stock is derated quite a bit. It's getting to a really attractive valuation. That doesn't automatically mean it's going to be a good stock. But if you can get sort of a continuation in engagement growth, continuation in membership growth, ad revenue is really starting to drive a re-acceleration in total revenue growth. And on top of that, if they end up with this great Warner asset, I think it still strikes me as a pretty interesting multi-year story. But investors probably going to have to continue to be patient with this one.
All right, John, always appreciate your insights. John Belton, of course, fund manager over at Gabelli Funds. A closer look at Netflix. The shares are now down about 4% here in the after-hours trade. The biggest decliner in the after-hours session, at least among the large caps. UAL, the biggest gainer in the aftermarket. But we got to go back and talk about what actually happened during the cash session. Bailey Lipschultz joins us right now, helps to lead our markets coverage here at Bloomberg. A 2% down day on the S&P, something we haven't seen in a few months here, and raising a lot of questions about what created that downdraft, and more importantly, did the dip buyers come back in tomorrow, or are they still going to be shook?
I would guess that they do. I mean, obviously, we're going to keep an eye on the Asia trade, but when you look at kind of what happened going into today's session, a lot of jitters around what Donald Trump is going to do, whether we're going to have a taco trade play out, built into a broader risk-off market globally. So you look at the stocks that have rallied the most, you look at the industries that have led this rally, NVIDIA down more than 4%, Apple down 3.5%. These are your bellwethers. These are some of the stocks that have helped lift the S&P 500, help lift U.S. equities. Also looking at things like the Goldman Sachs Non-Profitable Tech Index, down more than 3%. So it does seem like this had been a moment building in time, because as much as we wanted to talk about Venezuela, Greenland, and other kind of parts of the market, we kept seeing stocks going up and to the right.
The interesting thing about it, though, is, I mean, particularly when we talk about the geopolitical risk and you overlay that with, corporate fundamentals, or at least the optimism around AI. I was looking at the memory chip maker. SanDisk was up like 9 or 10% on the day here. So there's still people who are still committed to some of these trades, at least the trades that maybe don't have as much exposure to the geopolitics.
Well, I think the big thing when you look at a SanDisk or you look at an Intel, you look at these areas that maybe the trend hasn't played out just yet or to the fullest. So if you look at NVIDIA selling off, maybe if you're an investment manager, you say, okay, maybe we over-index to NVIDIA, but I like the idea that SanDisk is going to be the kind of leader when we look at memory. Maybe that's the trend that has legs in the first quarter. Maybe first quarter earnings are going to kind of deliver a gut punch to certain industries. Well, at least we can find certain areas of shelter. That had really been the Mag 7 when you look at 2025. When markets would be jittery, people still would say, well, at least NVIDIA's up.
Yeah, it's interesting that the Mag 7 had sort of been positioned as these macro agnostic names, that you weren't going to dent their appeal. Obviously, that narrative has flipped and then some. But it's interesting, I mean, to think about what's going on in the bond market right now. And I just wonder how that is filtering through. I mean, we're up about 6 basis points when it comes to the 10-year Treasury yield. Not exactly panic levels, but we're back at 4.30 or thereabouts when it comes to the 10-year. And I think that certainly has caught a lot of people by surprise.
Well, again, you look back at what happened with JGBs in Japan. You look at kind of the overnight action leading into today. We had seen this play out when you look back to various times, like the yen carry trade a few summers ago, even earlier when we saw Sell America be all the rage back in April of last year. There were a lot of kind of knee-jerk reactions that would happen in Asia, and they'd sometimes fizzle out. When you came into the market today and you have everyone in Davos, when you have people kind of worried about what the U.S. kind of, how the U.S. fits into uncertainty geopolitically, it looks a bit different.
But can I ask you a question, though? If we had not seen that trading session in Japan with that broken auction effectively and that big rise, do you think we would have seen such a pronounced move lower in assets, primarily here in the U.S.? Because, I mean, the Greenland stuff, the Venezuela stuff, yeah, it's a little scary, but, again, this is Trump we're talking about. The JGB thing seemed a lot more tangible.
No, it's more tangible. When I talk to sources, it's kind of like that's an actual event that does matter. And when you look at how capital flows from a global standpoint, JGBs matter for a U.S. investor. Everything is interconnected in that way, as opposed to, okay, at least we can brush off, talk about Greenland that seemingly was escalated over the weekend, but maybe not with the back and forth of tariffs, actually results in something other than a taco trade.
And it's also fascinating that, you think about what's going on in the bond market, its relationship to the stock market. I feel like bonds have been an unreliable hedge for a while. That is especially true today. But then you take a look at gold, just continuing its record run. I don't know if it was haven flows that explained what it did in 2025, but at least today you could make the case that this clearly is a safety trade.
That's a safety trade. Bitcoin below 90,000, maybe not a safety trade. No, I think that when you kind of look at the cross-asset positioning, when you say, okay, well, gold continues to march up and to the right, at least there's an argument that were things to completely unfold, at least you're protected there. I do still talk to people who kind of question, all right, how much does gold actually fit into a portfolio across assets, and what does that ultimately look like, just given how much of the metal has rallied, how much silver has rallied, and other commodities?
Yeah, certainly. It's a fascinating conversation, one that I think we're going to continue to have in 2026 if we see these metals continue to rally. That is Bloomberg's Bailey Lipschultz reporting on all things markets. Meanwhile, let's take a look at some of the big movers after hours. United Airlines reporting earnings in tandem with Netflix. So maybe we haven't paid enough attention to it because shares currently higher by about 4.5%, Romaine.
Yeah, and it's like we talk about this idea of sort of that higher end passenger. It's something that we've heard a lot from all the 3 big U.S. airlines, Delta, United, and American, this idea here that they are keeping things afloat. But it's kind of interesting. We remember when we got Delta, I mean, they actually fell largely because they missed estimates, and there was some concern here earlier that they weren't feeling as much as the back of the plane, but it looks like, at least for today, United getting a bit of a pass on that. Investors more confident about their situation.
Yeah, absolutely. Certainly a rally in shares. We'll see if that holds through. The Open Interactive Brokers, their fourth quarter adjusted EPS actually beat estimates. Shares down about 0.7%, and Xion's rising a little bit as well, currently higher by about 2.4%. Still ahead, the battle for Warner Brothers and how it can impact the streaming landscape. We'll talk all about it. Also, Netflix's expansion into live events and gaming as well. A lot of different angles to pursue. Don't go anywhere. This is The Close. Well, let's turn back to shares of Netflix falling after reporting earnings at the top of the hour, currently down about 5% after hours. Our next guest says, quote, "We need studios, particularly streaming-focused players like Netflix, committed to a robust slate of theatrical films." Joining us live, I'm pleased to say we have Paul Dergarabedian. He is senior media analyst over at Comscore. Paul, it's great to have you with us. And an interesting moment, too, because there are a lot of concerns as to whether or not Netflix is committed to the theater, to those theatrical releases. And I wonder if that's a concern that you share.
I do. And I'm hoping that given the success of Warner Brothers in 2025, which was built on the back of their theatrical slate, which was so amazing. I mean, the top grossing movie of the year, a Minecraft movie, that's a Warner Brothers film. Fast forward towards the end of the year, one battle after another Warner Brothers film, which is a major awards contender. And they're responsible for $4.4 billion in global theatrical revenue, Warner Brothers. That's about 13.2% of the global $32 billion in theatrical box office. So we just want to see that continue. And as Netflix as a streaming service primarily, I think the concern is that the focus, or will they, I hope, realize there's a huge value in having Warner Brothers as a perfect partner, as a theatrical engine, if you will, putting movies into the marketplace that people can see on the big screen. That adds to their value once they wind up on the small screen.
Well, Netflix would say, and their co-CEO has said that, it's not that they don't like theaters. That narrative doesn't really hold water with them, but that basically that they want to shorten the release window, that they don't think that long exclusive theatrical runs for movies are consumer friendly. And, if we do enter into that world where, Netflix through Warner Brothers is still releasing movies, but for for shorter periods of time in the theaters, how does that sort of change the environment in your view?
That's huge. I mean, that's the big factor here. Look, a long theatrical window, look, it has to be reasonable. I'm not saying it should be, 120 days or something like that. But I think a theatrical window that inspires people to go to the theater, the movie builds buzz. Look at The Housemaid, for example, and Zootopia 2. Those films have been in the marketplace for weeks and weeks. Zootopia 2, almost coming up on 9 weeks in the theater. The Housemaid, 5-6 weeks in theater, still going strong, still top 5 movies at the box office. So I just think there needs to be a recognition that a window where the consumer, we understand that if we need to go see that in a theater, eventually it'll wind up on streaming, but too short of a window, a lot of people might wait. I think that lowers the perception of the prestige factor of these movies. And then again, when they wind up on streaming or on the small screen, movies that, when The Housemaid, Zootopia 2 finally hit streaming, they're going to blow up huge because of that, that buildup, that long tail, if you will, of their theatrical release.
There's a big question, though, Paul, when we talk about just the future of movies, or at least of theatrical movie releases. The idea that, as we've known for quite some time, the big budget, the blockbuster tentpole movies, they still do well at the theaters. Those sort of indies, prestige type of movies, not so well. And in fact, that's been the bread and butter for Netflix and some of the streaming services, kind of taking that pie there. I guess the question is, what's the balance? If for some reason they were to acquire Warner Brothers Discovery, why even make the commitment across the board blanketly for theatrical release? Just say, look, okay, when the next big superhero movie or whatever Warner Brothers has comes out, we'll put it in the theaters. But if it's something less than that, we don't.
Well, that's a great question, Romaine, because if you look at a movie like Marty Supreme, that's a movie that is more of an independent type of movie as opposed to a giant blockbuster that's known IP. I think it's really the decision makers in these companies who have to decide, like, is the spend on marketing to go into theater worth it at the end of the day? And will they get more from a movie ultimately all in if they go theatrical first? But it really depends on the movie and the marketing, and of course budgets matter, because a lot of these films, these blockbusters, their ROI is, it's very difficult to get there with some of these movies having these enormous budgets. So I think that's going to be, but look, I'll go back to this. If you look at what Warner Brothers did in 25, that's a blueprint for success, starting with Sinners. That was a huge, well, really a Minecraft movie, then Sinners, F1, Superman, Weapons, One Battle After Another, all these huge films from Warner Brothers. They did a great job. I think let's just keep that going. You can learn a lot from what Warner's did. And if Netflix indeed wants to continue the theatrical success, go with the formula created in 2025 by the Warner's marketing and distribution teams.
All right, Paul, always great insights out of you. Always appreciate you jumping on here on these busy days. Paul Dergarabedian is Senior Media Analyst over at Comscore, as we keep the conversation going right now with Simon Gallagher. He's Managing Director over at SPG Global, and prior to that has spent quite a few years in the entertainment industry, including as Hulu's Director of Strategy, Netflix's Director of Content Acquisition, and even helped establish TCW's entertainment technology business. Simon, great to have you here. I do want to start off with the idea of what you expect Netflix to be. I was looking through your notes and something really jumped out at me, and I'm just going to read it to you. You wrote it, so I'm sure you know what I'm going to say. Netflix isn't trying to be bigger, it's trying to be harder to replace. What does that mean?
Well, it's all about engagement, and you'll see when you get a chance to look through the shareholder letter, you'll see that they've made a number of references to engagement, and particularly number of hours of engagement that they're generating around the world. So it's not so much, we've seen a 9% increase in the number of paid subscribers over the past 12 months to 325 million, which is a great number, very impressive, up from where they were a year ago, because everyone had a feeling that they were tapping out. Now it's less about increasing that paid subscriber number, but increasing the number of hours of engagement from the subscribers, but also the ad-funded layer. So they just want to have better content, more premium content, less what you might have previously referred to as just streaming content. And that's where the Warner Brothers Discovery acquisition comes in.
So when we talk about, I mean, we're all familiar with the deep library that WBD would actually bring to Netflix, and particularly, as you say, kind of those recurring series and series, I should say. I guess the question, though, Simon, is that enough for engagement, just the content of itself? And I ask that because even in the shareholder letter today, they talk about Tudum and some of these new projects that they've launched to keep people engaged, even when those series aren't on the air. The idea that they want you talking about it, they want you engaging with it. Are they doing enough there?
You can always do more, but certainly Tudum is a good idea, but they need to do more to, we've all suffered through that discovery process on Netflix. There's just too much content there, and it's about the presentation of content and how they're helping people unearth it. So through Tudum, through other assets that they've got, through other strategic marketing, it's all very important. And also to be very regionally focused as well. You know, things like the baseball classic in Japan and catering specifically to that market certainly will have some appeal in the US, but very limited in other markets. So not just about helping people discover, but also helping people discover on a regional, country-specific basis.
And you think about the fight for eyeballs, and you think about sort of the attention auction. I'd love to talk a little bit about YouTube and looking far out into the future, beyond this earnings season, next earnings season, this Warner Brothers deal potentially here, Simon. You think about YouTube eating everything. How much of an existential threat is that for something like Netflix?
Well, you always go back to the Reed Hastings famous quote of winning that moment of truth when people sit down on the couch at night. And absolutely, YouTube is currently winning that moment of truth. People are engaging with YouTube, but they're doing it on different devices as well, and they've got that higher engagement number. This, again, goes back to Netflix needs to be what it's very good at, and that's premium, scripted, and also unscripted content, and not user-generated content, not premium user-generated content. So there's still very different products, but obviously with you see the quality of content on YouTube stepping up very consistently with things like Mr. Beast and the budgets that he's spending on his content. But then as soon as it reaches a critical level, you've got interest from other streaming partners. So the market isn't just automatically migrating to YouTube. They're building an audience on YouTube, but then they're exploring offers from all the potential buyers.
Yeah, no, it's a fair point, but certainly you have seen that quality stepped up. I want to talk to you a little bit about the conversation we were having before this when it comes to the potential theatrical release window. If Netflix is ultimately successful here in acquiring Warner Brothers Discovery, there's a lot of questions as to what that means for theatrical releases, whether or not you're going to see those windows shorten up, which basically the company has said that they plan to do. I like how you phrase this in your notes, that theatrical isn't ideological, it's economic. Walk us through what you mean there.
Yeah, I've spoken to a number of media outlets talking about there's an opportunity once you complete the Warner Brothers Discovery acquisition to have different pricing tiers. And that's a step away from what Netflix has traditionally done. They've always loved simplicity in their pricing model. But what the Warner Brothers opportunity presents is perhaps a opportunity to get discounted movie tickets or even free movie tickets. We don't know yet because the acquisition isn't closed, nothing's been announced. But I would expect they'll start to explore something for super fans of movies, that they might be able to use their Netflix subscription and go in and, again, I'm guessing a little bit here, but I think go in and secure discounted movie tickets. So it will still drive people to that theatrical release.
I am curious here, Simon. I mean, you worked briefly at Netflix. I know that was some time ago. I just want to draw on a story that the New York Times put out last week. They had an interview with Ted Sarandos, and I think the headline, they kind of framed it as this idea that Ted Sarandos doesn't think anyone really understands what Netflix is. And when you look at the share performance, particularly over the last 6 months or so, it seems like a lot of investors don't understand and have moved away. What is Netflix right now? And more importantly, what is it going to be 10 years down the road?
What it is right now is a positive cash flow business that's spitting off cash and has had a fairly healthy share chart right up until about 3 months ago. And then, 2 months ago when they really dived in on the WBD acquisition. So, but what it also is the largest aggregator of credit card details on the planet. So they have 325 million people that are currently putting their credit card details down to buy content from Netflix and buy access to the service. There's a lot of things that Netflix can do with that user base. So it's one thing right now, but it's all about, we've seen them step into the licensing of podcasts. I think you'll start to see them anywhere that people are engaging with content or entertainment. I think there's an opportunity for Netflix. So I don't think they've even scratched the surface in terms of what they are, because what you can do with those 325 million credit card details is extraordinary.
All right, Simon, got to leave it there. Great to get some time with you. That is Simon Gallagher. He is managing director at SPG Global and a former strategy and content acquisition executive over at Netflix and Hulu. More Netflix coverage coming up next. This is The Close on Bloomberg. Well, we're keeping an eye on shares of Netflix, down about 5% on the back of their latest results. And of course, ad revenue, a key figure to watch for in this report. And the streaming heavyweight says that they see ad revenue doubling in 2026 versus 2025. Let's discuss now with Mountain CEO Mark Douglas. Mark, it's great to see you. And I wonder what you make of that sort of qualitative judgment, given that, again, we don't know the base number of that ad revenue figure.
Yeah, I mean, at the scale they're at right now, I think that's a reasonable expectation. But I think what's kind of even more interesting is the last reported numbers last year from Netflix is 1 out of every 2 new subscribers are buying the ad-supported tier. And so even if the revenue gets to that scale, there's still so much money left on the table for them that they can grow into. And I think it's going to be a big part of Netflix's future growth. So it's that backlog of ad revenue that they're not yet monetizing, even though the consumers are saying we want to receive ads. I think it's a big part of their future story.
And Mark, of course, a big topic of conversation always, but especially in this earnings report, is engagement. Whether or not Netflix is attracting those eyeballs and winning those eyeballs. And the conversation we were just having with Simon Gallagher was, how do you compete against a YouTube in the years, in the decade to come? And I would love to hear your thoughts on that.
Yeah, I mean, I think people should think of YouTube and Netflix is very different. The way I think about it is YouTube owns the day and Netflix owns the night. And so I'm using YouTube. I think most people using YouTube, watching podcasts, short form, user generated content. But the big tentpole, like the latest release from Netflix, The Rip, that's not on YouTube. That is nighttime content that people want to sit down. It's theatrical scale movies, live sports, all these things. And that's what Netflix owns. And most interesting, I think it is far easier for Netflix to go down into the day, meaning podcasts and other content, than it is for YouTube to come up and produce theatrical quality content.
Well, expand on that a little bit, because they do talk today a little bit, and we should point out that conference call kicking off now about the push into video podcasts, obviously the push into gaming, but at the same time, and these are their words, they talk about, quote, how the competitive lines are increasingly blurring, and they actually cite YouTube's deal with the Oscars, which kicks in, I think, in 2029.
Yeah, I mean, obviously YouTube Google has the scale they have as a company. They want to continue to grow their user base, but I think it's a much tougher play for them. And I think also it doesn't feel natural to the entertainment consumer, right? In other words, you buy a Netflix subscription because for most people, this is proven data, it's the first place you go when you turn on the TV. I don't think, for YouTube to take over that spot in the consumer's mind when they're sitting on the couch, laying in bed, wherever they're watching that kind of content. I think you can do it with a show or two, but I think it's going to be very hard to do it at scale.
So I do have to ask you about the potential. When we talk about the build out of the ad business, and we should point out they're commenting on that now on the call, saying that they can grow that business pretty aggressively this year. Does acquiring something like Warner Brothers actually aid in that in terms of the content that they bring to the table, or is that maybe just something completely different?
No, I think it definitely aids in that in terms of the content they have. Big shows like White Lotus, the HBO catalog, just quite a bit of like top quality content. Even I'm not 100% sure where they're getting rights to Discovery's content, but all of the content from Discovery. So I think it's very important. It does give more to sell. Also, Warner Brothers has a very, very established ads business, and I think it's a little underestimated as to what that can bring in terms of having thousands of experienced sellers with relationships and who know how to operate in this business. Netflix is growing that. It's not, they're probably trying to recruit those people right now, but I think bringing one big ad sales team out of Warner Brothers is like a hidden gem if they win this acquisition war.
All right, Mark, I have to leave it there. Always appreciate your insights here. A closer look at shares of Netflix, still under pressure here in the after-hour session. Mark Douglas there. He is the CEO of the ad tech Mountain, which actually was just named Ad Age's best place to work for a third consecutive year. When we come back, we're going to set you up for what to watch over the next 24 hours, and, well, it could be a doozy. Stick with us. This is Bloomberg.
Well, all eyes on Davos as President Trump prepares to speak in front of the World Economic Forum tomorrow morning. Joining us now to discuss the state of play in Davos is Christina Ruffini. She covers U.S. politics and foreign policy for Bloomberg. It's great to see you.
Thanks for having me.
So we heard from President Trump earlier today saying in regards to Greenland, you'll find out. So not a lot of answers there, but I have to imagine that is the big question heading into his speech tomorrow.
I mean, this has sucked all the oxygen out of Davos. This is all anyone is talking about. My phone actually started blowing up at 5 a.m. with European sources pinging me, asking me what was going on, which is never a great sign. There's a bit of a sea change in the European officials I've talked to. There's this taco concept, right? Trump always chickens out. I've got to tell you, I covered both administrations. I never heard that term before this week, but now everyone's using it, so I'm going to co-op it as well. This feels different, and this feels different to European leaders, and they are very serious about taking action on this. You know, Trump, as you said, they asked, how far are you willing to go to acquire Greenland? He said, you'll find out. And then he was asked again, you know, Greenlanders don't want to be part of the U.S. And he said, well, when I speak to them, they'll be thrilled. You can't get him off this fixation, and that's concerning to Europeans.
With regards to the reaction to it, not only by world leaders, but by the market, some people have been trying to draw parallels to what we saw in April with the tariffs.
Right.
That seemed a little bit different because you were negotiating something that, A, was a little bit more tangible and absolutely, to a certain extent, realistic. When you start talking about seizing Greenland, when you have reports, news reports, that Canada has now mapped out a scenario for an invasion by the U.S., which just seems bonkers to me. we're beyond the realm of just, well, he might chicken out. I mean, these are tangible threats. Is there a tangible response?
There is, and I asked European ministers about the three options: tariffs, the bond dump, and then Trump was asked about all those European investments, do those go away? And I was told tariffs are very real, and Europeans, even though they're divided about how to deal with this, are on the same page, and they will enact tariffs if this continues, if the rhetoric continues. The bond dump is harder because it's not all in public hands. You have private companies, it's more complicated. And I was surprised, the comments I got back were the investments are really hard to pull. That's something that's already in the works. That's going to be much harder. But look, Europeans are talking about taking action. They're also starting to ask, to your point, what is this really about? Because the U.S. can have as many military bases in Greenland as it wants. Greenland is part of NATO. The U.S. is part of NATO. Is this really a defense argument or something else going on there?
Yeah, and it raises a lot of questions. A lot of people say, oh, this is just a negotiating tactic, but maybe we'll find out over the next few days at Davos. Christina Ruffini helps to lead our foreign policy coverage here at Bloomberg as we set you up for what to watch over the next 24 hours. And then, of course, it includes quite a bit going on the corporate front first, believe it or not. Katie Greifeld, earnings tomorrow morning.
Absolutely. J&J taking the stage, so too is Halliburton, Charles Schwab as well. And then 8:30 a.m., I mean, that is really the big event of tomorrow morning.
Yeah, President Trump set to give his speech at the World Economic Forum in Davos, a speech that ostensibly his people have said is going to be about affordability and the economy. Speaking of which, we are going to get some economic data as well at 10 a.m. tomorrow here, East Coast time.
Yeah, in the form of U.S. construction spending. We also got pending home sales, certainly a focus for this administration. And then at 1 p.m., this normally I don't think we'd highlight it, but we have that 20-year auction. Yeah, that could be important, particularly coming off the ructions we saw after that big auction in Japan, and a bit of a revolt by investors here as a lot of people looking at those long-term yields. Meanwhile, we come back to the corporate space, and tomorrow is the deadline, believe it or not, Katie Greifeld, for Warner Brothers Discovery shareholders to decide whether they want to take that offer from Paramount Skydance. Are you taking it? I don't know about that. We know that Warner Brothers would like if their shareholders didn't go with the Paramount offer. It seems like they clearly prefer Netflix.
And on the monetary policy front, the Supreme Court is set to hear oral arguments in that case as to whether the President of the United States has the power to fire a Fed governor. This is The Close.